Hi, thanks very much for having me today. And I'm afraid that I have been a victim of the technological disruption today. So Alan Gray will be controlling my slides. Apologies if we are a little rusty. But I'm very excited to join you today. And I was actually quite worried when I saw that I was the last person on the roster, because usually when I'm at a conference nowadays, all of the other speakers have talked about ESG or sustainability, and I have nothing left to say. So actually, this is quite a pleasure because I feel like the other speakers have kind of skirted around the topic with discussions of culture and renewables and externalities, but I can't believe I've not heard anyone use the acronym ESG yet. So I'm actually here to persuade you that we don't need to use that acronym, that this is going to be something that we don't talk about at all in 10 years' time, because it's going to be so completely mainstream and embedded in the way that we all invest. So I am a portfolio manager of our Global Sustainable Growth Fund, which is our flagship sustainable strategy here at Schroders. And I'm going to talk to you about our concept of corporate karma and some of the investment opportunities that we see arising from that. So if we look at our first set of slides, so sustainability, it feels kind of like it's really taken off in the last few years, but if you take a longer term view, it's actually been much more of a slow burn, though it has accelerated recently. So you can see on the left, the regulatory push. This has been led by Europe, but I suspect other geographies will be getting there fast. And then the client pull, that our clients, both on the institutional and retail side, are showing increasing enthusiasm for sustainable investments, worrying about the impacts that their investments have on the wider world. You can now see that almost all of the RFP activity we get globally now includes some ESG. And the financial imperative for the industry to shift is also really clear. You can see on the right-hand side that ESG has been the only area of equities that has been getting inflows for the last few years or until very recently. And assets under management in the space are now over $2 trillion, but it's still only about 10% of total global assets. So there's a long way to go here before it becomes completely mainstream. But COVID has been quite a clear catalyst for more people to start thinking about ESG. And our own surveys at Schroders here have shown us quite how material this has been. So we first got on the left-hand side our institutional clients that we surveyed. So these are accounting for around 27 trillion of AUM, the people surveyed here. And you can see that the vast majority are saying that COVID has raised the profile of ESG within their investing or within their organizations. Almost no one is saying it's become less important. And on the right-hand side, this is even more the case when you get down to retail investors, that 80% now care about aligning their value with their values. So investing in a way that meets their sort of personal and ethical principles. So hugely important client push here. And I'm pleased to say that at Schroders, this is not a new idea to us either, that we've been doing sustainability for over 20 years. Before it was cool. We've got, I think the slide says 22 permanent staff, but actually we're well on our way to 35, I think is where that team is going to be in a couple of years' time. So strong track record there. And I mentioned this concept of corporate karma up front, and I wanted to explain a bit more about that because I think this is critical to the investment implications of sustainability. So we believe very strongly that there is no trade-off between sustainable investing and returns if you do it in the right way. And that is because of this kind of concept of corporate karma, that the way a company impacts and treats its stakeholders will ultimately come back and impact its shareholder returns. We're all trying to invest in companies that can achieve supernormal growth and returns over a long-term investment horizon. And in order to do that, you need to look after your wider stakeholders. You can think about a company's relationship with its employees, for example. The impact that a company has on its employees is fairly straightforward. It's the wages and benefits that it pays them. It's its care of occupational health and safety, diversity, training spend, all those kind of things. And you can think of a company that maybe can maximize its short-term earnings by underinvesting in some of those areas, by paying employees the bare minimum when the labor market is quite loose, for example. But ultimately, that will result in higher turnover, which is extremely expensive for a company. It results in an inability to attract and retain the really best talent, and talent is the real scarce resource in today's economy. High risks of things like strikes and walkouts or occupational accidents. And all of that also has a knock-on impact on a company's reputation with its customers, because as one of our previous speakers mentioned, people care a lot more about the values of the companies that they shop with now. And the implications from an investment point of view, there's strong evidence that because of this corporate karma dynamic, companies that are run with a stakeholder-centric view produce superior operating performance over time. And the nice thing for us as fund managers is that there's still a remarkable amount of market inefficiency when it comes to pricing that in. I think our first speaker showed a slide of the average time frame that the market is looking at. And certainly when you look at things like US markets, everyone is focused on their forecasts for the next quarter or at most the next year. No one's really thinking about the sort of 5 years plus time horizon, which is really when the value is created, where in a DCF the value comes from in a business. So we can exploit that market inefficiency by thinking longer term and looking at these stakeholder relationships and the corporate culture that underpins a company's ability to grow and compound over that time frame. And the best evidence I can give you of that is that the bulk of the alpha that we've generated in my strategy has been from names that we have owned for 5 years plus and have just continued to execute and perform, and the market has ignored it. So how do we go about finding these sustainable companies? It's all very well and good to say that this is what we're looking for. I wanted to put a small shout out for having a proprietary approach to assessing sustainability. And I think as this becomes increasingly mainstream and something that is required of all fund managers, we need to go beyond the obvious sources of information. And so far, that's been the likes of an MSCI or a Sustainalytics, where everyone's familiar with the kind of the grades or the scores or maybe Morningstar Globes that are put on funds. But there's quite a lot of issues with these third-party assessments. I mean, more than anything, as this becomes embedded in your investment process, it's just too important to outsource. It would be like taking your investment research from just a single broker and just, I'm just going to buy whatever UBS say or whatever Merrill say. This is something that should be deeply integrated in an investment process. There are various biases inherent in the scoring methodologies. So you can see on the left here that they tend to skew towards larger companies and certain geographies where there's more disclosure legally required or where there's more resources available for ESG disclosures. Doesn't necessarily mean those companies are any better run. It just means that they're devoting more resource to trying to tell you that they are. We don't want to have a system that just rewards disclosure. We want to get under the skin of companies and see how they really operate. You can also see on the right here that the different ratings agencies are remarkably inconsistent. So maybe 40-50% correlation at best between different scores. And you can pick on individual stocks. I saw we had Tesla on one of the slides earlier. They really divide the ratings agencies. They'll be sort of top quartile for one and bottom quartile for another. And that's not because anyone individually is wrong, just because there's a lot of complexity and subjectivity in how you look at an individual company. And nothing in this space is black or white. So you can think about, a company making electric vehicles or wind turbines or solar power. That's great from an E point of view. But if you're then making it with forced labor or conflict minerals, then it's not quite such an easy decision. So we believe strongly that you need more of a qualitative approach. So more like the kind of thing you would be doing as a fundamental investor, looking at companies. You're not just trying to model and put the data together. It's about the value of the analysis that you do, the debates you have with a diverse group of people. And I like to quote Einstein here that not everything that counts can be counted and not everything that can be counted counts. So things like corporate culture are really hard to get through the data. The only way you get that is by a long and deep relationship with the companies that you own, by speaking to the stakeholders directly, by kind of doing your scuttlebutt, looking at things like Glassdoor and employee reviews, try and get a more holistic view of what the company is really doing. I wanted to finish up with one example of a stock that we've owned for an extremely long time in this strategy, and really exemplifies a lot of the things we're looking for from our holdings. So Safaricom is probably one that is relatively familiar to this audience. I'm used to talking to global guys who've never heard of it. But for anyone who hasn't, it's a Kenyan telecommunications company. But more interestingly, it runs the M-Pesa money transfer platform. And around 50% of Kenya's GDP flows through that platform. It's hugely important. And this company really demonstrates that you can do good for society and for your stakeholders without it being to the detriment of your shareholders. So the societal impact of Safaricom, from their infrastructure, from their employment, and from that value that's in M-Pesa. So when M-Pesa was introduced, it was the first mobile money platform really in the world, way before we had anything like this in the West. Only 14% of people in Kenya had bank accounts. It's still only 40% today. So this has had a transformative impact on the economy. And Safaricom is one of the first companies I ever came across that tried to do impact measurements. And they commission KPMG every year to assess their impact. And they find that it is consistently over 10 times the profit of the company in positive externalities. So the opposite to the aluminium example there. On this, our own assessment internally, we call it the SQ, the Sustainability Quotient. You can kind of see that web in the middle where we've assessed their relationship with all their different stakeholders and found them generally very strong there. A couple of areas of relative weakness, for example, on environment, where they are still quite reliant on diesel generators to run some of their telecoms towers, given the grid issues in Kenya. But we've been engaging with them on that, and they are rapidly transitioning to solar and renewables for those sites. And on the right, you can see the sort of proof of concept that this has really been borne out for shareholders. In the time we've owned the stock, I think it's roughly quadrupled. And this is in US dollar terms as well. So that's a really encouraging sort of story and a demonstration of how this can all work together. And we also see this dynamic in the wider portfolio level across our portfolio. So we have a tool at Schroders we call SustainX, shown on the right-hand side, which tries to measure the positive and negative externalities of companies. Aluminium is actually a really good example that we also look at through that lens. And we are reporting across our funds at Schroders the impact of our investments, as well as the sort of risk and reward. We really think this is going to be the third dimension of investing that clients are looking for going forwards. So what we're hoping to show is that we can deliver consistent outperformance and also do that without it being of detriment to society or the environment. I feel a little vulgar that I'm the only person in the panel who's showing performance. So that does flash up on the next slide, but we can probably leave it there. Thanks.